Welcome to the research desk. Imagine knowing exactly what the future looks like. Imagine knowing with absolute certainty that a new technology is going to completely transform the global economy.
Like the internet or the railroad.
Exactly, like the internet or electricity. So you invest everything you have into building the foundation for that future. And you are proven entirely correct about the technology.
But you still lose your shirt.
You lose every single penny of your investment. Today, we are asking if the artificial intelligence boom is setting up investors for that exact same trap.
It is a terrifying prospect, honestly.
It really is. I am taking the bull case here. My position is that financing infrastructure far ahead of proven monetization is not a mistake. It is the necessary, rational, and, frankly, historically proven path for any general-purpose technology.
Okay, but at what cost?
Well, that is the thing. You cannot build the economy of the future without overcapitalizing the present. The companies deploying hundreds of billions of dollars today are securing the foundational layer of a completely new computing paradigm. If they do not build it now, they forfeit the future.
I come at this from the bear perspective, though I want to be extremely clear about what I mean by that. I'm not a Luddite here. The technology is entirely correct.
Right, we agree on the tech.
Absolutely. Artificial intelligence will change the world. But the securities are disastrous. What we are witnessing right now is a catastrophic misalignment between capital allocation and the reality of cost deflation.
You think the infrastructure is just too front-loaded?
The infrastructure being financed right now is front-loaded to a degree that completely defies historical financial modeling. I mean, we are seeing hundreds of billions of dollars deployed into assets that are depreciating in economic value infinitely faster than they can be monetized.
So you see it as a financial trap?
It is a massive financial trap. The cost of generating artificial intelligence, what we call inference, is just collapsing. That creates a massive surplus for consumers, sure, but it entirely destroys the pricing power required to justify the capital expenditures of the companies buying the hardware.
But that is just building ahead of demand.
No, we are not just building ahead of demand. We are building extremely expensive, rigid capital structures in an environment defined by hyper-deflation.
Okay, let us lay the groundwork so we understand precisely what kind of cycle we are in. We are dealing with artificial intelligence not as a software application, but as a true general-purpose technology.
Okay, set the stage.
To really grasp the economics, you have to view this through the lens of electrification. Think about how electricity actually changed manufacturing.
You mean the shift from steam?
Exactly. Before electricity, a factory was built around a single, massive, centralized steam engine. Every machine in the building had to be physically connected to that central engine.
Through those crazy overhead belts, right?
Yes, through a complicated, highly dangerous system of leather belts and overhead shafts. And because of that physical constraint, factories had to be built vertically. The layout of the machines was dictated entirely by proximity to the power source.
Not by efficiency.
Right, it was not driven by the logical flow of the assembly line at all. Then electricity arrived, but it did not just cleanly swap out the steam engine for an electric motor.
It changed the whole floor plan.
It allowed for unit drive, meaning you could put a small, dedicated electric motor on every individual machine. That changed the entire architecture of the factory. It allowed for single-story buildings. It literally birthed the modern assembly line.
Which reshaped cost structures everywhere.
Fundamentally reshaped them across every conceivable industry. Artificial intelligence operates on that exact same structural level. It is a fundamental shift in the production function of the economy itself.
I follow the logic, but the scale of the spending is what breaks the model.
Because of the scale of the shift, the scale of the build-out must match the scale of the eventual utility. The upfront capitalization appears staggering in isolation, I grant you that, but it is entirely proportionate when you measure it against the total addressable market of human cognitive labor.
Proportionate? So what actually happened? Think about this for a second. The industry is on track to spend between $635 and $690 billion on capital expenditures in 2026 alone.
Which is a massive acceleration.
It is roughly 70% above 2025 levels. One major bank is projecting $1.15 trillion of cumulative hyperscaler spending from 2025 to 2027.
It is an astronomical figure.
We must pause and internalize the gravity of those numbers. We are talking about capital outflows that rival the gross domestic product of entire sovereign nations, and it is all compressed into a 36-month window.
But again, they are building the grid.
Here is the fatal disconnect, though. Current direct artificial intelligence revenue covers only about 15% of that AI-specific capital expenditure.
15%?
Only 15%. If you look at the most widely cited venture estimates, the ecosystem needs roughly $600 billion in annual revenue just to justify the current infrastructure being built.
And where is actual revenue sitting?
Against that $600 billion requirement, actual revenue is sitting between $50 and $100 billion. Let me frame it another way, because this ratio is the absolute crux of the entire bear case.
Go ahead.
We have $200 to $250 billion in core infrastructure capital expenditure, pitted against $50 to $70 billion in direct application revenue.
So that ratio is?
That is a revenue to Capex ratio of 0.20 to 0.35. For every dollar these companies are spending to build the factory, they are generating 20 to 35 cents of direct product sales.
It is a steep deficit right now.
In any mature capital cycle, a ratio that brutal is not a footnote. It is a warning siren. It indicates that capital is being incinerated in the pursuit of a market that does not yet exist in any proportionate financial scale.
Okay, I see the math you are presenting, and that gap is undeniably enormous. But to view that specific 0.20 ratio as a warning siren is to commit a fundamental analytical error.
How is basic accounting an analytical error?
Because it misinterprets how platform transitions actually work. Judging a foundational platform by near-term revenue matching is completely flawed. Foundational systems deliver their payoffs downstream.
Through secondary effects.
Yes, they manifest through second-order and third-order effects that are practically impossible to accurately price at the exact moment you are deploying the initial capital.
But the gap is historically wide.
Asking if today's artificial intelligence revenue justifies today's infrastructure spending is exactly like asking in 1996 whether hourly dial-up fees justified the capital cost of laying the physical internet backbone across the ocean floor.
The AOL days.
Right. At that time, consumers were paying America Online $20 a month for heavily restricted, incredibly slow internet access. If you looked at those subscription revenues and compared them to the billions of dollars required to lay transatlantic fiber optic cables, the math made absolutely no sense.
It looked like a terrible investment.
Exactly. But it was the wrong metric applied to the wrong time horizon. Historically, the network must exist before the economy can reorganize around it. Look at the railroads in the 19th century.
The classic example.
You do not wait for the freight to arrive at the station before you lay the track. The track creates the geographic and economic reality that makes the freight possible. The capital expenditure must precede the ecosystem formation.
The problem with the railroad analogy is that many of the original railroad investors were completely wiped out.
Well, yes, there were bankruptcies.
The physical track remained in the ground, sure, and society benefited immensely from the transportation network that resulted. But the initial equity was driven straight to zero by overcapacity and crushing debt.
But the value was created.
Economic value creation for society is absolutely not the same thing as investor value creation for shareholders. The most direct historical precedent we have for this exact dynamic is the fiber optic boom of the late 1990s.
You mean companies like Global Crossing?
Exactly. Companies like Global Crossing and WorldCom laid tens of billions of dollars in internet backbone, and their core technological thesis was completely undeniably correct.
They knew traffic would surge.
They bet that data traffic was going to explode as the internet grew. The world absolutely needed more bandwidth, and frankly, their traffic growth forecasts were actually quite accurate.
So where did it break down?
The financing and the timing were fatally misaligned. Capital markets funded too much capacity way too early. Because the capacity arrived long before the monetization models were mature, vicious price competition set in.
Right, a race to the bottom on pricing.
When you have massive fixed costs and a totally commoditized product like raw bandwidth, prices drop to the marginal cost of zero, which entirely crushed returns.
Which led to the defaults.
Global Crossing filed for bankruptcy in January 2002. It was one of the largest bankruptcies in United States history at the time.
And yet the internet thrived.
The internet went on to change everything. It created extraordinary, unprecedented global wealth. But the build-out layer, the specific companies that actually laid the physical pipes, first destroyed a massive amount of the capital that funded it.
A cautionary tale, certainly.
Being right on the technology and wrong on the securities is one of the oldest and most painful ways to lose money in public markets.
That is a compelling story, I will admit. But the fiber optic analogy ignores a crucial difference in the nature of the assets being built and the corporate entities building them today.
How are they fundamentally different?
The clean, directly applicable corporate precedent here is not global crossing. It is the early era of cloud computing. We really need to look at the Amazon Web Services precedent in full to understand what is happening right now.
Okay, let us look at early AWS.
In the early 2000s, Amazon invested aggressively in data center and server infrastructure. At that time, their core retail business was still proving its long-term viability to the market.
Wall Street hated the spend.
They hated it. To Wall Street, those infrastructure outlays looked incredibly heavy. The margins looked razor-thin, and the strategic logic appeared indulgent, if not outright reckless.
Because they were just a bookstore.
Exactly. Financial analysts demanded to know why a digital bookstore was buying so many physical servers. The spending was initially justified by their own internal compute needs for the e-commerce platform.
But they built way beyond their own needs.
They were deliberately building vast excess capacity. And then, when Amazon officially launched AWS in 2006, they transformed that entirely misunderstood, quote-unquote, excess infrastructure into one of the most profitable, high-margin monopoly platforms in modern business history.
It was a brilliant pivot.
The lesson of that 2006 AWS launch is profound. A company willing to build ahead of visible demand creates a moat that competitors simply cannot cross once the demand actually materializes. What looked like reckless excess on the income statement became the foundational architecture of the modern internet.
AWS succeeded because computing demand was elastic and Amazon maintained relative pricing discipline as they scaled. What we are seeing in artificial intelligence infrastructure today is entirely different.
In what way?
It is a deflation trap. This is the single most underappreciated point in all current analysis of the sector. Let us define inference costs for a moment, because it is the linchpin of this entire debate.
The cost of the output.
Right. When we say inference, we are talking about the actual computational cost of the artificial intelligence answering your prompt or generating a token, which is essentially a piece of a word.
And those costs are dropping fast?
Those inference costs are falling by 50 to 200 times annually in certain domains.
Which expands the market?
Every fall in compute cost expands the market, absolutely. But it does not necessarily expand the margins of the companies providing the compute. Deflation of this magnitude destroys pricing power for the infrastructure owners.
Because the models get cheaper to run?
Exactly. If the quality of the output continuously improves, while open source or lower cost models radically narrow the performance gap, profit margins will collapse infinitely faster than aggregate demand can grow.
You are assuming a total loss of pricing power.
This technology can create massive consumer surplus and still be a mediocre, capital-destroying business for the companies buying the hardware. Think about the implications of the DeepSeek model that recently shook the market.
The efficiency gains there were shocking.
DeepSeek demonstrated that a mere fraction of the standard compute budget can achieve performance that closely rivals the frontier systems built by the biggest players.
It really shook up the assumptions.
That development did not merely lower cost. It violently attacked the core economic assumption behind these enormous hardware commitments. The entire bull thesis relies on the assumption that the highest spenders will preserve a durable technological edge long enough to earn excess returns on their invested capital.
And if that edge decays quickly?
If model efficiency improves faster than the infrastructure can be depreciated on the balance sheet, then today's massive server fleets become the equivalent of brand new passenger aircraft purchased just weeks before a revolutionary new engine slashes fuel costs across the industry.
A stranded asset scenario.
Exactly. The airlines with the old planes cannot compete on ticket prices, and their multi-million-dollar assets become instantly obsolete. The hardware obsolescence here is a moving target.
But these are not airplanes?
We are not just building a factory before demand arrives. We are building a factory whose incredibly expensive machinery may be entirely outdated before the ribbon-cutting ceremony. And remember, roughly $180 billion in artificial intelligence venture funding poured into this ecosystem from 2023 to 2025 to chase this.
I want to address that airplane metaphor directly because it fundamentally mischaracterizes the nature of computing hardware.
How so? It is depreciating hardware.
You are interpreting cost deflation entirely as a margin killer, when semiconductor history proves it is the ultimate market expander. This is the pure Moore's Law intuition at work.
Lower costs mean higher volume.
Yes. When inference becomes radically cheaper, entirely new use cases become economically viable. At a high cost per token, you only use artificial intelligence for high-value tasks, like drafting legal contracts or writing complex code.
Sure, specialized use cases.
But when the cost per token drops by a factor of 200, it becomes economically viable to have artificial intelligence monitor every single frame of a security camera feed in real time, or continuously optimize the routing of thousands of delivery trucks down to the second.
Volume explodes.
More developers experiment, more enterprises deploy the technology deep into their operational workflows. Lower cost per token is not a mechanism of value destruction at the system level. It is the exact mechanism by which value creation accelerates and proliferates.
But the hardware itself still ages out.
Furthermore, you are treating these data centers as if they are rigid, single-purpose industrial assets. A cluster of graphics processing units is not identical to a blast furnace in a steel mill or a pipeline built for a single depleting oil field.
They are still highly specialized.
But GPUs are highly versatile compute assets. The same massive clusters used for training the most complex frontier models can often be repurposed seamlessly for inference.
Or for other compute needs.
Exactly. For fine-tuning specific corporate models, for complex scientific simulation, for advanced graphics rendering, and for bespoke enterprise workloads. The data centers themselves are entirely modular.
The physical shells, yes.
The billions being poured into liquid cooling infrastructure, specialized fiber networking, and dedicated power generation are investments that will support multiple future generations of hardware.
I will grant you the power and cooling.
This physical adaptability does not completely eliminate the risk of stranded assets, but it drastically lowers it relative to the rigid industrial booms of the past. Underinvestment is the true fatal risk here.
Underinvestment?
In platform markets characterized by data gravity, meaning the tendency for large data sets to attract applications and compute power to them, and developer ecosystem pull, a company that fails to secure compute, secure energy, and secure networking at the exact right moment will permanently lose its position.
So it is a race for control points?
The capital expenditure right now is not a simple discounted cash flow exercise you run on a spreadsheet. It is a mandatory race to own the control points of a completely new computing stack.
The financial strain of that mandatory race is no longer theoretical, though, and it cannot be waved away by pointing to long-term adaptability.
Where do you see the strain breaking?
Where is this financial strain showing up today? It is not hiding in some abstract future projection. It is sitting right in the current cash flow statements of the most powerful companies on Earth.
The cash flows are definitely feeling it.
Let us walk through the actual balance sheet bloodbath we are witnessing right now. Alphabet's free cash flow is projected to fall by roughly 90% in 2026, entirely due to these capital expenditure commitments.
90%?
Let that sink in. A monopoly with one of the greatest business models in human history is watching almost its entire free cash buffer evaporate because it is forced to buy hardware at this pace.
And Amazon?
Amazon's free cash flow has already compressed to about $11 billion over the trailing 12 months, while they are simultaneously guiding to an astonishing $200 billion in 2026 Capex.
The Capex numbers are historic.
Let us talk about impairment charges, because this is where the theory hits the accounting reality. One major company has already taken a $1.4 billion impairment charge on artificial intelligence infrastructure that was built over a period of just 24 months.
A $1.4 billion write-down that fast is brutal.
Let me walk through exactly how an impairment charge works so we understand the severity of this. You build a data center and fill it with specialized servers. You tell your accountants that these servers will generate revenue for 4 or 5 years, so you spread the costs out over that time on your balance sheet.
Right, standard depreciation.
But if demand does not show up or the hardware becomes obsolete faster than expected, you are legally required to admit that the asset is no longer worth what you paid for it. You take a massive immediate hit to your earnings to write down the value.
Admitting defeat on the asset?
Taking a $1.4 billion hit on hardware that is barely 2 years old happens strictly because of severe underutilization. On top of that, Microsoft is reportedly actively canceling massive data center leases.
Pulling back on physical footprint.
These are not speculative, bearish talking points drawn up by short sellers. This is early, tangible, irrefutable evidence that asset duration assumptions, utilization models, and return expectations have been wildly, dangerously optimistic.
Driven by the venture boom.
And remember, this was all accelerated by venture capital behavior. They completely detached from unit economics. As I said earlier, roughly $180 billion in artificial intelligence venture funding poured into this ecosystem from 2023 to 2025.
Chasing the narrative.
That capital chased the narrative of strategic inevitability well before durable recurring monetization models were actually established. Capital rushed in, built the capacity, subsidized the initial usage, and is now discovering that the inevitability of a technology does not magically guarantee attractive unit economics at every layer of the stack.
Those cash flow compressions you are pointing to are absolutely real, but they are exactly what creative destruction looks like in real time.
Creative destruction is usually a bit less self-inflicted by monopolies.
We are witnessing the intentional strategic redeployment of capital from mature business lines into the foundation of the next decade. The fact that Alphabet or Amazon is willing to compress their near-term free cash flow is a testament to their absolute conviction in the terminal value of the platform.
Or their sheer panic about losing market share.
It is not a signal of structural failure. Their leadership teams understand the historical precedents we are discussing today. Again, the internet did not fail simply because dot-com equities collapsed in the early 2000s.
But a lot of portfolios did.
The value is absolutely created. The only relevant question for a sophisticated observer is not if the value will be created, but who ultimately captures it. Financial expansion naturally outruns productive returns during the nascent phase of any general-purpose technology.
It gets ahead of its skis.
The academic research on unstable investment cycles clearly demonstrates that periods of exceptionally heavy capital spending almost always precede the actual productivity gains. The critical analytical mistake is assuming that just because a boom looks financially stretched on a 12-month income statement, it must therefore be technologically or strategically wrong. It is structurally necessary to overbuild.
I am not arguing the technology is wrong. And I agree the overbuild might be historically normal. But I am pointing out that the macroeconomic ripples of this specific technology pose a unique threat.
To what, specifically?
To the very aggregate demand that these companies rely on to justify their capital expenditures. This is a crucial distinction from the internet era.
You mean the labor market impact?
If artificial intelligence replaces white-collar labor income faster than it lowers the cost of goods and services, aggregate demand across the broader economy weakens.
Because the displaced workers buy less.
Exactly. The sustainability of this trillion-dollar infrastructure build-out ultimately depends on someone somewhere paying for the outputs. If we enter a world in which white-collar productivity rises significantly, but white-collar wages and overall employment fall, that is not automatically a world of healthy economic demand.
Automation usually shifts labor rather than destroying demand entirely.
Previous waves of automation targeted routine, physical tasks on the factory floor. Artificial intelligence is explicitly targeting writing, coding, financial analysis, customer support, and administration. It is targeting the cognitive middle of the labor market.
Which has massive macro implications.
The cultural and market signals are already flashing red on this risk. We saw a very specific dystopian thought exercise regarding white-collar displacement hit the market recently.
The American Express example.
The premise was simple. If artificial intelligence does the work of all the junior analysts and mid-level managers who currently hold corporate credit cards, corporate travel and spending will plummet.
That really moved the stock.
That thought exercise was severe enough to tangibly knock American Express shares down, forcing the company's leadership to publicly defend their posture regarding their exposure to artificial intelligence.
And we are seeing headcount reductions elsewhere.
We saw Block cut 4,000 jobs amid widespread market suspicions that they were simply using artificial intelligence as a convenient excuse, what the market calls AI washing, to justify massive headcount reductions.
And it is not just in the U.S.
We are seeing reports out of Paris describing a very real chill wind of AI-linked job losses in the corporate sector. Most notably, short-selling skepticism has widened dramatically from single, overvalued tech names to the index level itself.
Shorting the S&P 500 based on AI displacement.
We have sophisticated investors who have moved from being completely sanguine on the market effects of this technology to being openly skeptical of the S&P 500's overall earnings durability. If artificial intelligence hollows out the purchasing power of the exact workers whose tasks it automates, demand will disappoint at the exact moment the infrastructure owners need maximum utilization to service their massive capital investments.
That brings us to the most critical variable in this entire analysis. We have to talk about the commoditization wildcard and what we call the rent map.
The rent map is everything here.
Both the bullish and bearish perspectives often make the mistake of treating artificial intelligence as a single, monolithic asset class. It is completely differentiated across the stack. The key question is not whether the technology creates value. We know it does.
Right.
The key question is identifying precisely which layers of the ecosystem will capture the economic rents after the rapid commoditization of the baseline intelligence occurs.
Who actually keeps the cash?
When economists talk about economic rents, they simply mean who actually gets to keep the excess cash generated by the productivity boom. Because inference prices are falling by 50 to 200 times annually, the baseline output of these models is becoming entirely commoditized.
Which is terrible for the model builders.
Therefore, the highest returns will absolutely not go to the entities simply selling raw intelligence. The premium returns will flow directly to whoever controls the remaining unyielding bottlenecks in the physical and digital supply chain.
The choke points.
We are talking about the entities controlling dedicated power generation. We are talking about specialized, high-bandwidth optical networking that connects the servers. We are talking about the manufacturers of premium next-generation semiconductors.
That is where the scarcity lives.
In almost every infrastructure boom in modern history, the overarching benefits diffuse broadly to society, but the actual economic rents are captured by a highly concentrated few. Society gets the massive productivity boost, enterprise customers get structurally lower operating prices, the financiers who funded the undifferentiated overcapacity absorb the brutal write-downs. We must map the future rents based on scarcity, not just scale.
We are already seeing this bifurcation happen in real time across the market. The rent map is exposing the winners and losers right now. Just look at the extreme divergence in corporate outcomes over the last few quarters.
The numbers are incredibly polarized.
You have Oracle experiencing what they term a code red moment of unprecedented demand for their specific infrastructure configurations. You have Han Hai thoroughly beating market profit estimates based on relentless demand for their hardware integration capabilities.
Hardware integrators are printing money.
And on the exact same day, you have major cloud operators taking billion-dollar impairment charges on their assets and actively canceling long-term data center lease agreements.
It is a tale of two markets.
The technology is one overarching story. The rent map is a completely different, highly localized reality. If you are trying to translate this fundamental disconnect into an actionable portfolio strategy, the directives become very specific.
What does the playbook look like?
The playbook for the next 12 to 18 months requires a strict barbell approach. You must systematically separate the AI beneficiaries from the AI financiers. The strategy requires an 8 to 10% overweight position in those selective, unyielding infrastructure bottlenecks, where the scarcity is demonstrable and physical.
And within that tactical framework, you maintain a 10% overweight exposure to the undeniable core layer. We are talking about names like NVDA, AMD, DLR, and EQIX.
The chips and the landlords.
Exactly.
These are the entities manufacturing the crucial compute engines, or, in the case of Digital Realty and Equinix, acting as the specialized landlords for the entire ecosystem. They provide the power, the cooling, and the network pipes that the massive computing clusters physically require to function.
But you cannot just hold them blindly.
However, this positioning comes with a crucial, non-negotiable caveat. This is a highly sensitive capacity cycle. If global GPU utilization falls below 70% for 2 consecutive quarters, that is the definitive signal that supply has catastrophically outstripped demand and pricing power is breaking.
Below 70% utilization.
Utilization simply means the percentage of time those expensive chips are actually running calculations for paying customers versus sitting idle. At the exact moment utilization drops below that 70% threshold, you must instantly cut that specific exposure completely back to market weight.
You run for the exits.
You cannot hold through a structural utilization collapse. Furthermore, you must treat all hyperscaler capital expenditure announcements as an acute cash flow risk, not merely as a visionary growth narrative.
No more cheering for big Capex numbers.
When you see massive 90% free cash flow declines or management teams guiding to $200 billion annual Capex plans, that demands extreme valuation skepticism. You must demand a higher risk premium for that equity, regardless of how sound the underlying strategic logic may be for the decade-long platform transition.
Precisely. And the aggressive side of this portfolio strategy directly addresses the massive overcapacity we discussed earlier. You take a 3 to 10% short exposure over a 12-month horizon on specialized, undifferentiated AI infrastructure providers.
The generic providers.
I am talking about companies whose entire economic model relies on owning large, generic clusters of GPUs and simply renting them out by the hour. They are uniquely vulnerable to both the hypercost deflation of inference and the brutal repricing of short-term leases as supply floods the market.
They have no moat.
They have high debt loads and acute customer concentration. You maintain that short exposure, but you cover it immediately if you see enterprise AI application revenue begin to compound at 20% or more quarter over quarter on a sustained basis.
That 20% mark is the signal.
That 20% quarterly growth metric is your empirical proof that genuine, sticky enterprise demand has finally arrived to absorb the massive supply glut. Until you see that specific metric hit, the generic infrastructure layer is a value trap.
The strategy makes perfect sense.
The overarching rule of thumb for this entire era is simple. You own the adopters before you own the wrappers. Because inference costs are plummeting 50 to 200 times a year, the most durable, profitable winners will be the traditional incumbent firms that successfully utilize artificial intelligence to systematically lower their internal operating costs.
Not the startups selling generic AI products.
The losers will be the thin-moat application wrappers trying to sell generic, commoditized AI outputs into a market where the price is trending rapidly towards zero.
When we synthesize all of these dynamics, we actually converge on a very specific verdict. The reductive public discourse constantly demands a binary answer.
People want to know if it is a bubble or a miracle.
People want to know if this entire movement is an absolute bubble or if the current staggering spending is perfectly rational. The actual truth is far sharper and much more demanding of our attention. The reality is that artificial intelligence is deeply economically plausible, but highly financially fragile.
Economically plausible, financially fragile.
This is creative destruction operating in a far more concentrated, significantly faster moving, and much more financially leveraged form than we have ever seen in the history of capital markets. The economic gains will be extraordinarily uneven, and the capital destruction will be severely front-loaded onto the companies building the foundation.
It is a terrifying transition period.
I will leave you with the exact framing from our source material today, which summarizes the entire phenomenon perfectly. The real question is not whether AI changes the world, it is whether the people financing the transition survive long enough to own any of it.
If intelligence becomes too cheap to meter, what becomes the most valuable, scarce resource in your industry? This is the Research Desk officially signing off.